2026 is the first year BTS is back as a full group on a stadium tour. Revenue has been breaking records all year. $499 million in the first quarter, then $1 billion in the second, more than double, the biggest quarter in the company's history. But at the same time, HYBE recorded a $140 million operating loss in the first quarter. Stock performance down 58% from its February peak. Record sales, a company posting losses, a market that cut the price in half. How are all three true at once? Today we take that paradox apart. What a stadium tour does to the income statement. Why spending big on concerts make a quarter look broken when it's not. And whether the market is over-punishing HYBE's stock. I'm Ko, and welcome to the Ko Report on Korea. Let's dive in. HYBE's founder Bang Si-hyuk made $286 million from a profit-sharing deal signed before the HYBE IPO. That deal is now under investigation of fraud. This year, the same man, accused of misleading investors and banned from leaving the country, handed out $182 million of his own stock to every employee in the company. It's hard not to see this as reputation management. In the year all eyes were on him, he made the gift in the most visible way a founder can. On paper, those shares hit the first quarter books as an expense, as a loss. That is the $140 million operating loss from the top. But this is an expense only under accounting standards. It has nothing to do with the actual business performance. It's what's called a non-cash expense. Cash actually went up. The accounting is a bit technical, but the result is simple. When a founder's share come into the company, they count as capital. They never touch the income statement. The moment the company hands them to employees, it's treated as if a bonus was paid, booked as labor cost, the same way salary or bonus are. So an expense only on paper amplified the loss. But strip the whole accounting bullshit out, and the margin was already collapsing, 3 years in a row. 14%, 8%, 2% by last year. 2025 was HYBE's biggest year ever, $1.9 billion in revenue. And 2026 is on track to break that revenue record again. But look at 2025 and the profit line is odd. The more HYBE sold, the more the selling ate the profit. Revenue grew $272 million over 2024, and gross profit, what is left after paying the direct cost of delivering those sales, fell. The new sales alone came in at 106% cost ratio, which means every extra $1 of revenue took about $1.06 to deliver. So how much does HYBE keep from $1 of each sale? It depends on what the mix is made of. In 2024, when album sales led the mix, gross margin was 43%. In 2025, as concerts took over the growth, it dropped to 35%. And in the second quarter of 2026, the biggest revenue quarter the company has ever had, with the stadium tour at full scale, 32%. The quarter HYBE sold the most was the quarter it kept the least. The cause is the mix, what the extra revenue was made of. Concerts drove the growth. 8 out of every 10 new dollars came from live shows. Concert revenue hit $546 million, up 69% in a single year, while albums shrank 10%. And a concert's cost grow at the same speed as its sales. Every added show means another venue rented, another stage built and shipped, another local crew paid. It is a business where getting bigger doesn't make the margin better. We covered this machine in an earlier report on how K-pop makes its money. But as mentioned before, what a concert makes is not profit. It's the audience it's making. The audience goes on to buy the album, buy the merch, and buy the monthly fan platform membership. And once that fan exists, everything else is cheap to sell. The album is already recorded, one more copy costs almost nothing. The membership is already built. One more subscriber is a new row on a server. The merchandise is designed once and sold at a markup. Basically, concerts carries costs that climb with every ticket sold. But the second wave of profits, the albums, the merch, does not. Both waves are visible in HYBE's own books. In 2025, the year concert revenue jumped 69%, the merchandise and licensing line jumped 36% right beside it. $300 million to $408 million. The fan club and membership line has grown every year, $65 million in 2023 to $97 million in 2025. And YG's actual numbers show exactly this. After a major tour, the merch line rises with a lag. In 2025, Blackpink came back and toured the world. YG's concert revenue peaked in the fourth quarter of 2025 at $42 million. But its merch and product line peaked one quarter later, $47 million in the first quarter of 2026, the highest in YG's history. This happened just as the tour was winding down. The stage was built in one quarter. The harvest arrived in the next. The income statement cannot show this lag. When a company builds the factory, the spending becomes an asset and the cost is spread over the years the factory runs. A concert gets no such treatment. It's an investment in future customers, but every dollar of it is charged to the quarter the show happened. The planting quarter carries the full cost of the seed and none of the harvest, so it always looks like the worst one. A concert does not make the money, it buys the customer who does. The market read that income statement at face value. 5 straight months of double-digit declines, 58% off the February peak. For most of the slide, the market was not the problem. The Kospi was setting all-time highs into June, while HYBE dropped double digits month after month. Only the last leg came with the market's help, an 11% one-day crash on July 28th. And even inside that crash, money kept finding companies with earnings. A handful of consumer goods companies rose while the index fell. HYBE printed the biggest quarter in its history and got dumped anyways. To be fair, HYBE did fumble its recent acquisitions. It wrote off $117 million of them last year, and $588 million of goodwill from its biggest US deal still sits on the balance sheet. But still, I personally think the market is over-punishing HYBE. It read a planting quarter's income statement and called it a crop failure. And for reference, on valuation multiples, the stock now sits at the lowest point in its listed history in terms of how much the market is valuing the company based on its earnings. HYBE is now trading back where it stood nearly 6 years ago, in its first months as a listed company. We'll have to see how this all plays out. Thank you for watching the Crew Report on Korea. I'm Koo, and I'll see you in the next report.